In this week's video, we'll review the latest charts and data to help us understand what we should be watching now to better understand the stock market's risk-reward profile in the context of inflation, interest rates, and Fed policy. We'll be moving quickly, so feel free to use the pause button on your video player. We want to stay focused on the topic in the lower left-hand corner of your screen. Thus, we'll try to focus on the most important topics in this week's video. This is a slide from last week's video. You may remember that on Friday of last week, a week ago today, we said that we recorded the majority of last week's video on Thursday evening, and that ended up being a good thing. Thursday was an extremely weak day in the markets, and the charts basically told us to try to be patient. As it turns out, there was a massive rally on Friday, allowing us to see firsthand how charts can be useful relative to thinking long-term, even in the context of shorter-term volatility. Fast forward a week later, and something similar happened this Friday on May 31st. The charts on your screen, you can see up here, they were pulled at 2:27 p.m. Eastern Time on Friday, May 31st. You can see at that time, VU, or the S&P 500 ETF, was down 0.3%, 2:30 p.m. Eastern Time on Friday. The triple Qs were down 1.47%. And the charts that follow were pulled during the day on Friday, and the basic gist is going to be the big picture still looks pretty good, and we should try to be patient. That also turned out to be useful because before the close, there was a late-day reversal, and the S&P 500 reversed sharply. The S&P finished up 42 points on Friday, May 31st. There's a 1-minute chart of Friday's session. After the PCE numbers were released, they basically came in line with expectations. The market opened green but quickly reversed. The low of the day was hit around lunchtime, and then you can see late in the day we rallied sharply into the close. This is 3:30 p.m. Eastern Time here. Let's get back to the original message. These are the charts that we looked at on April 26th. And the basic gist was, relative to the ETF shown on your screen, all of this volatility up here was occurring within the context of a longer-term uptrend. These charts are dated April 26th at 1:21 p.m. Eastern Time. If we looked at the same charts during Friday's session, when most of these ETFs, if not all of them, were red, the same concept applied. All of this volatility up here in SCHG is occurring within the context of a longer-term uptrend. And by the time the closing bell came, the primary trend reasserted itself, and most of these instruments rallied sharply into the close. Also noteworthy at the close on Friday, May 31st, the VIX was down almost 11% and closed under 13. Something fairly significant that happened as a result of that late-day reversal on May 31st was SCHG, XLK, VU, the S&P 500 ETF, and the triple Qs, the NASDAQ 100 ETF, were able to print higher highs above these pre-pullback highs on monthly charts. So, for example, intraday on Friday, XLK was hovering right around these levels here, and we weren't really sure if it was going to print a higher high on the monthly chart. So for the month of May, XLK finished up 7.09%, SCHG growth up 6.2%, VU, the S&P 500 ETF, up 5%, the triple Qs, the NASDAQ 100 ETF, up 6.39%, and your laggards over here, home builders, small caps, and the equal weight S&P 500 lagged the ETFs on the left side of the screen, but they were all green as well. RSP was up 2.85% in May. It has yet to clear this high. Same can be said for IWM. It didn't clear this high, nor did Home Builders ITB. But ITB was up 2.25% for the full month. IWM up over 5%. So your market leaders, large cap tech, and large cap growth, all printed new higher highs on the monthly charts, and that's significant, and that's what you would expect your leaders to do, lead. Now, it's possible there's going to be some catch-up trades in the coming weeks, very, very similar to what happened during Friday's session, and that's a good thing. We still want the laggards to participate in the rally, and we still want the laggards to have healthy charts. And that's exactly what we have. This is ITB, IWM, and RSP during the session on Friday, May 31st. all daily charts. Thus, while things didn't look particularly appealing during the session on Thursday or intraday on Friday, May 31st, the longer-term trends were still in place. The monthly charts ended up doing some nice things in the month of May. And these scores that were calculated during the session on Friday when the S&P was down approximately 30 points all told us to try to be patient. Trend strength model, all inputs, all time frames, a strong 97. The long-term trend strength model, 100 when the S&P was down approximately 30 points. Similar message for the secular volatility model, all looking strong despite the short-term weakness that we've had or some of the bumps in the road that we had during the week. The Bloomberg headline from May 30th on the left side of your screen would also tell us to try to be patient. We would think this would be good news. Bonds set for best month in 24 as inflation fades. So daily S&P 500 anchored volume weighted average price chart intraday on Friday, May 31st at approximately 10:24 a.m. Eastern, when the S&P was down 14 points up here in the right-hand corner of your screen, upper right. The message here, as long as the S&P 500 stays above 5167, it's extremely easy to classify this up here as volatility to ignore. So it turns out the intraday low today was 5191. This data up here is after the close when the S&P finished up 42 points. So 5191 down here, we did stay above 5167. If that didn't hold next week, 5055, that general area, would be another good reference. There was nothing particularly alarming here intraday, nothing particularly alarming at the close. I was also thinking in normal retracement terms during the day today. Pulled this chart earlier today when the S&P was down approximately 29 points here in the upper left-hand corner of your screen. The thought process was for the month of May, the low on the 60-minute chart was 5011.05. The high up here recently was at 5341.88. If we had a normal retracement of this A to B move, so this would be point A down here, this would be B, and typical retracements, 38.2%, 50%, and 61.8%. What does that mean? It means within the context of an uptrend, it's not unusual to retrace 38.2% of a gain, half of it, or even 61.8% of it. And if that were to happen, we would retrace 126 points of the 330-point move, 165 points of that move, or approximately 204 points of that 330-point move from point A to point B. And if we did that from this peak here, that would take us back approximately to either 5215, 5176, or 5137. And we just said on the last slide, the close, it ended up being that the intraday low was 5191, right in between these two numbers that were calculated earlier today, meaning this is a 100% normal and to be expected retracement within the context of an existing uptrend. And why is this relevant? Because if you retrace 38.2, 50%, or 61.8% in the context of an uptrend after that normal retracement, the uptrend remained in place. By definition, you would go on to print a higher high eventually above this high here. As we know now, the 29% intraday loss earlier today ended up being a 42-point gain by the close. Short-term concerns would increase if the S&P 500 undercut 5137 in the coming days or weeks. The longer below, the more meaningful it would become. That did not happen today, and we closed well above this figure at 5277. Let's update our XLE relative to XLK chart. As you might remember, when that ratio spiked here in calendar year 2022, that's when the market had increasing concerns about inflation, interest rates, and Fed policy, and that was during the bear market here in 2022. The lower portion of the screen is the S&P 500. During Friday's session, around 10:06 a.m., upper left-hand corner of the screen, the ratio was below that mustard line that we talked about in previous videos. Very, very easy to remain patient if the ratio remains below these levels here. Some additional downside wouldn't be surprising in the market if this ratio popped up to level G here, which is similar to level D here, where the correction ended in Q4 in the S&P last year down here. Thus, this white space here tells us to keep realistic expectations about the possibility of ongoing volatility. Right now, this still tends to lean towards the correction is over camp. We wouldn't be as confident about that if the ratio starts to clear these lines in here. That may happen next week. Hasn't happened yet. It's kind of a busy chart. There's a lot going on, but the message is try to be patient. This is the NASDAQ relative to the S&P 500. If you know stock market history, risk-on periods typically see the NASDAQ outperform the S&P 500. Going back to 2013, the ratio of the NASDAQ composite to the S&P made a stand near this blue anchored volume weighted average price line tied to this low in 2013. It did it in 2014 here, 2016 here, and again in 2023 here. The ratio also exceeded the anchored volume weighted average price line tied to this 2021 high here. And so far, all of this volatility in here has stayed above this mustard colored anchored volume weighted average price line tied to the 2023 low. If you're a regular viewer of these videos, the message on this chart here is very, very similar to the message on this small cap chart that we've been covering. And you may remember that this message is similar to the message for the S&P 500 and SPY in May of last year. You may remember in May of last year or in Q1 of last year, the S&P 500 consolidated above all of these important anchored volume weighted average price lines and eventually started to take off in mid-May in a bullish manner. So this is small caps IWM. They're still laggards, but the chart at 11:15 a.m. Eastern Time on May 31st still has a similar message relative to what we've seen in recent weeks. It's saying, try to be patient with small caps, and also try to be patient with the risk on trade. There's nothing alarming here, and the bias should be to the upside longer term. That would change significantly if IWM moves into this area down here. The longer it stays there, the more concerning it would become. But notice how long we've been above the lines in this area up here. That's significantly different from all of this back here. The same can be said here, NASDAQ relative to the S&P 500. It's indecisive, and it makes sense that it's indecisive. The market is unsure about inflation, interest rates, and Fed policy, but it's leaning towards the bullish end of the spectrum. And this chart in its present form says the odds favor this ratio moving in this direction longer term. Those odds would shift if the ratio moves into this area here. That may happen very, very soon. It just hasn't happened yet. So all of these charts can help us with both bullish and bearish probabilities. Very, very similar concepts here. Triple Qs, QQQ relative to the S&P 500. Really the difference here is the triple Qs are the NASDAQ 100. This chart is the entire NASDAQ composite. It's broader. We always get the why so many lines. Trying to find lines that would be above price, that would act as potential resistance. If you can't find them, it basically says you have potential support below price. So this chart too, indecisive, but the bias unquestionably is to the upside. Look at the slopes of the anchored volume weighted average price lines and contrast them with the slopes in here rolling over in early 2022 during the bear market. As long as this ratio stays above this orange line here, which is tied to this 2021 peak, we're still in try to be patient mode. So the message here is also similar to the message here. Just like moving averages, these tight clusters in here tell you we're at an important point. This is strong potential support, just as it would be strong potential resistance if we drop below it and stay below it. These are short-term undercuts. It's not unusual for the market to do that. And notice these slopes are trying to turn back up in a favorable manner. Again, earlier in the session on May 31st, 1:14 p.m. Eastern Time, this chart we described in detail either last week or the week before. This is LQD, investment-grade corporate bonds. LQD can also provide some insight into those key topics related to inflation, interest rates, and Fed policy. And right now, this chart too, as we've described in the past, is saying try to be patient. That would change if LQD moves into this area here. Very similar, and try to be patient and potentially bullish from a longer term perspective. Messages on this chart. This is a very broad index. This is the Value Line Geometric Index. Value Line follows approximately 1,700 stocks, give or take a few. Geometric indexes give equal weights to all stocks regardless of their market capitalization or price. So think of this as a good way to track the median activity of these 1,700 stocks. And you'll notice it looks very, very similar to the IWM chart, and it looks very, very similar to the S&P 500 chart in May of last year, a year ago. Important region in here. We'll see how it unfolds right now. It's leaning bullish. Don't seem to be hearing as much talk about how weak Apple is. Down here, it was starting to look vulnerable, but it too is holding and consolidating in a constructive region relative to the anchored volume weighted average price lines. And why is that relevant? It speaks to cost basis. And for the most part, it's telling you the average price weighted by volume. Most market participants up here are profitable, and it's much, much easier for them to be patient with a profitable position. That would change significantly if Apple moved into this region here. In 2023, it held near a logical area. These lines are tied to the COVID high and the COVID low. The recent pullback here held near a logical area as well, and we recaptured this orange anchored volume weighted average price line tied to the 2023 low. Once again, the indecisive look makes sense. The market's not sure about what the Fed's next move is, and the market is still tentative relative to inflation and interest rates. We could go through A, B, C, D, E, and F, finish up the eye chart, but the takeaway is there's nothing concerning here at this point. This too is a constructive chart that tells you the bulls are in control. All of that would begin to change incrementally if we drop below C, D, E, and F. But right now, all of these lines are sloping upward, and we're well above this pre-pullback high from earlier in 2024. You can see during the bear market here, this is 2022 in this region here. 2023 starts here. The equal weight S&P 500 RSP significantly outperformed the capitalization weighted or normally weighted S&P 500 or SPY. And that's basically saying that the big boys took a break. The mega cap tech players took a break and underperformed when the market was concerned about Fed policy, inflation, and interest rates. And just the opposite has been happening recently. The mega caps have outperformed, tech has outperformed, growth has outperformed. It's difficult to believe that that's a bad thing when those are your bull market leaders for several years. In fact, our buddy Dean recently did a study. For only the 9th time since 1966, the percentage of S&P 500 equal-weighted sectors with a positive relative trend score versus the standard-weighted S&P 500 declined to 0%. That basically says if you took the equally weighted sector ETFs for all of the S&P 500 sectors and compared them to SPY, they're all in a downtrend. Here's the key from Dean. Many believe that narrow leadership, meaning mega cap is leading, signals bearish outcomes, yet history contradicts this view. So what we have today, going back to 1966, only occurs about less than 1% of the time. The annualized returns during those periods, almost 25%, by far and away the largest annualized return figure in Dean's table. And how can that possibly be true? Well, it's possible that it's telling you that market participants have conviction about some type of story. There's something that they're confident about. Confidence isn't necessarily a bad thing. In the present day, what they're confident about is AI, technology, the potential for improvements in productivity. So these concepts in this chart here, and we've covered RSP, SPY numerous times over the past several years, also at the present time fall into the try to be patient category. We could talk about this chart, or most of these charts, for about an hour each. There's a lot to unpack here, so let's hit the highlights. The Federal Reserve controls shorter-term interest rates with Fed policy. They do not control directly long-term interest rates. Their greatest influence is on the shorter end of the curve. So when market participants are concerned about inflation, interest rates, and Fed policy, and they're concerned that the Fed is going to raise rates heading into 2022 here, all of this here was happening during the bear market down here in the S&P 500. We also had SHY, the 1 to 3 year Treasury bond ETF, take on a similar fractal and concerned look during the correction in the S&P 500 in 2023. And these are the anchored volume weighted average price lines here, tied here. Moral of this story is also very, very similar. If you were to look at the trend from October of 2022, when the stock market bottomed and the market starts to think differently about the outlook for interest rates, Fed policy, and inflation, you'll notice the trend in SHY reverses. This is a downtrend over here when bad things were happening. This is an uptrend. The last thing SHY did on its own in isolation was print a new high above this high here. It doesn't really look anything like the bear market. In fact, this new high here looks like this point here after the S&P 500 bottomed in Q4 of last year. Right here, we're exceeding this high here. And right in here, we start to pull away from the anchored volume weighted average price line tied to the pre-correction high. We're doing something similar on a shorter-term fractal basis here. SHY is starting to pull away from the anchored volume weighted average price line tied to this pre-pullback high. This is a smaller fractal of this here. After this fractal, good things happened in the stock market. This is just another chart telling us to try to be patient and err on the side of holding our positions. The message from this chart would change if we undercut these lows here, and more importantly, undercut this line here and these lines here. So let's recap. Down here, this still has the correction or pullback could be over look. Under the mustard line is similar to being under the black line here. And look, come down here. This is what happens in the S&P 500. Chart in front of us says try to be patient and try to give the bullish case the benefit of the doubt. And like every week in these videos, commentary about this chart and every chart is based on the chart in front of us. This ratio moves into this area or moves into this area. We'll have to reassess those probabilities. We trade the chart in front of us. Even when things didn't look that great, during today's session on Friday, May 31st at 2:27 p.m. Eastern Time, XLK was down 1.53%, finished green for the day, so had a very good 90 minutes heading into the close. What does that tell you? It tells you that institutions were buyers in the last 90 minutes today. All of this volatility was occurring within the context of clear uptrends. And by definition, uptrends make a series of higher highs and higher lows. What does that tell you? It tells you when all of this is going on, if you're patient and the uptrend persists, then eventually your position should go on to make a higher high. And that's exactly what happened on a different time frame. SCHG just made a new higher high on the monthly chart, nailed it down today on May 31st. XLK just made a new monthly closing high above this pre-pullback high. This is a higher low. This is a higher high. This is a higher low. This is now a higher high for VU that's in the books above this high here. Same thing can be said for the triple Qs. To capture all of this, all you had to do in here and in here and in here and in here was hold your position. And if we go back to the RSP versus S&P 500 or RSP versus SPY chart, the slopes of these important anchored volume weighted average price lines over here, and these could be moving averages as well, same concepts apply. These slopes tell us that the longer term trend is down. You can see they're all starting to roll over. What does that mean? That means most likely any move in this direction will be a counter trend move within the context of an existing downtrend. A counter trend move within the context of an existing downtrend. What do downtrends do? They make a series of lower highs and lower lows. So until proven otherwise, what this really means is the trend still favors large cap and large cap tech and large cap growth. And any move in this direction, until proven otherwise, will be treated as a counter trend move within the context of an existing downtrend. And we all know, if we're going to use all of this effectively, it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.